When the Fed did its pivot last week, when it seemed to act a little bit more dovish than everybody expected, one wonders how much they factored the China reopening into the story. Because increasingly, this story seems to be a bit of a, what shall we call it? A bit of a unknown variable in our whole model of what is happening out there. Hello and welcome to the Northern Miner Podcast. My name is Adrian Pocobelli, and I'm just trying to think this out, and then you look geopolitically. Russia has finally formally announced that it is going to reduce the amount of oil that it is shipping, which seems to be a direct response to the sanctions. So you put that, which seems to be an active attempt to stoke inflation as a strategy, right? I mean, it couldn't be more clear, could it? I mean, they're not making a secret about it. But then you put the China reopening into the mix, which will, of course, increase demand. One wonders what the Fed is doing by not retaining its ultra uber hawkish perch. So it's quite interesting. I mean, at the back of your head, you wonder to yourself, have they seen data that looks so terrible that is coming that they are just going, okay, no matter how much we want to reduce inflation and demand, there is such troubling data in the pipeline. As they say, monetary policy has delayed reaction, or however they put it, right? And that is what Jay Powell was saying. So it's quite the bind one wonders that the West could be in. And I mean, the pendulum so far is in the West's direction. So far, the West was completely bailed out by Mother Nature here, at least with the very warm winter in Europe, historically warm. So far, things have worked out to the West, but you kind of feel like the pendulum, as you see the markets there, with Bitcoin, right at $25,000, maybe it can go a little higher to 30, maybe it keeps going. I mean, nobody knows the future, and it's almost a fool's errand to attempt to predict the future. But, I mean, we have to do some outlooks and forecasts in this business. That is the nature of investing. Otherwise, it really is just blind chance, isn't it? But all to say, at least from my perspective, it kind of feels like the pendulum is caught in midair, at its height. Maybe it goes slightly higher and is ready to just go in the opposite direction. But who knows? Maybe this is just a overly pessimistic view. But as we're going to hear from GlobalXETF commodities analyst Roberta Caselli in this week's episode, there is definitely a tightness in the market. And I mean, some of the things that Roberta was saying about copper are quite stunning. And zinc, I didn't realize, remember the Javier Blas's book, The World for Sale, where the traders in there were calling aluminum congealed electricity. Well, Roberta was saying that zinc as well is one of those metals that are incredibly energy intensive. And she was suggesting that part of the reason for the stories that we saw a week or two ago with this kind of strange activity on 24-hour zinc with prices going really high, maybe suggesting that this is a result of these smelters that have been closing across Europe. And so anyways, it's a very interesting discussion with Roberta Caselli, again, of GlobalXETF, a commodities analyst. So that is a lot to look forward to. And as I was saying with Roberta, as you'll hear, the whole idea in Europe of, the weekend vacation is starting to evaporate. For the last perhaps 15 years, I've only been here for 6.5, but for the last, I'm assuming somewhere around 15 years or so, the era of cheap air travel in Europe, the idea of going to, Milan for 2 days, 2 nights, and flying back to Berlin was not a crazy idea. You might be able to do it for 100 euros. That seems to be disappearing. That whole, cheap travel around Europe. I mean, Everybody notices it. And not only is it in the airfare, but it is in the Airbnbs as well. So, inflation, how does it hit people? Well, maybe there also seems to be delays and lags in inflation itself. We were talking about the delays and lags in monetary policy. What about the delays and lags in inflation? Because sure, in the grocery store, you might see it first. But something like an Airbnb, that's kind of a cultural thing that happens over, months. It takes months, maybe a year, to really start to see the effect. And I think that's true for a lot of things. Like, I haven't looked for air travel that much here and there, but all of a sudden it's just like, this is expensive. And part of the reason for it, and again, this wild card in our big geopolitical mosaic, this narrative mosaic, is China and the China reopening. And from a purely geopolitical point of view, maybe you have to wonder that factored into President Xi's decision to just say, forget it, let's open up, let's stoke inflation in the West, we're having problems here at home anyway. People are getting mad. Let's just, open up and create some demand here, and we'll print a bunch of money. We'll put a bunch of liquidity into the system. So anyways, a lot going on here as always. And again, metals and mining increasingly are at the center of this geopolitical Mandela that we love to track here. So welcome back, everyone. It's going to be a wonderful show. And if you aren't getting enough from the podcast and the website, you can also attend one of our virtual mining and investment conferences. This takes place tomorrow, the Global Mining Symposium on February 22nd. It is free. You can register your interest, which should get you in at events.northernminer.com. It features Catherine Boggs, chairperson of Hecla Mining, Luca Giacovazzi, CEO of Wailu Metals, and Randy Smallwood, president and CEO of Wheaton Precious Metals, and also chairman of the board of the World Gold Council. So all-star lineup. We have a series of presenters as well, including Kendra Johnston from AME Roundup and several more. It's going to be a great show. So just go to events.northernminer.com to participate, and you have the possibility of asking any of these guests a question while you are watching. So that is very exciting. And with that, if you want to find us online, you can find us at northernminer.com. You can find us on Twitter at northernminer, and on Instagram at The Northern Miner, and on Facebook, LinkedIn, and YouTube, where we also host these podcasts, and wherever podcasts are available, including Spotify, Stitcher, Apple Podcasts, and SoundCloud. And with that, let's turn to the news. And turning to the website, BHP is hoping green shoots in China will help its profits, as last year they slumped. Pretty amazing. This is a Reuters article via mining.com. Global miner BHP Group reported a steeper than expected 32% fall in first half profit owing to a drop in iron ore prices, sending its shares down, although it flagged a brightening outlook in China, its biggest customer. So maybe that was the COVID lockdowns in China, because you would have thought last year, I assume when they say first half, they are talking about last year, you would have thought they would have been doing spectacularly. Continuing on, China's strict zero COVID-19 policy curtailed economic activities and dented demand over the past year, driving iron ore prices down from lofty levels while miners wrestled with surging costs and a tight domestic labor market. Well, that is a very good point, surging costs. And we're going to have another very interesting story, Barrick Gold's Mark Bristow, on how inflation costs are not coming down. As a result, the world's largest listed miner reported underlying profit attributable from continuing operations of $6.6 billion, down from $9.72 billion a year earlier, more than $3 billion less in profit. That is quite something, and a testament to inflation, isn't it? To costs of mining. That missed a VUMA financial estimate of $6.82 billion, as earnings from copper and coal came in lower than analysts had expected. BHP's giant Escondida copper mine was hit by road blockades in Chile that disrupted mining supply deliveries. However, its interim dividend of 90 cents per share, while down 40%, beat Vuma Financial's estimate of 88 cents. I was looking. Let me see if I can find that. I was on Google Finance, and here it is. Even still, like BHP is at $48. You look at the big chart here, and the highest it went was in 2022 at maybe $52 and $53 in 2021. And those are basically the all-time highs. So it's at $48, not far from its all-time high. And you know what the dividend yield is? 9.59%. So that is quite something. And I mean, this is a miner. It's really interesting. You wonder, it looks like it actually just did a double top there, but I am not a technician in the last few years. And yeah, it's going to be, as always, these markets always seem to be at an inflection point of some kind. And yeah, should these highs be broken, that could get pretty crazy in a good way for investors, not financial advice, of course. Shares of the global miner fell as much as 2.8% to $47.11 Australian. Their lowest since January 6th, and were down 2% in a broader market that was down 0.5%. And we have a quote from analyst David Lennox of wealth manager Fat Profits in Sydney. Quote, "We have got BHP as a hold primarily because their share price is sitting up at record highs, and they are going to have to do pretty well to justify those levels." You know what I find so strange? And of course, I am not a mining stock analyst. When you look at the price to earnings, it's 8.32. I guess that's on the higher range of where it's been previously. I remember we were looking at mining stocks when it was 3 or 4, on BHP, if memory serves. So they're considering those pretty high levels. According to David Lennox, the miner said it sees, quote, markedly higher, end quote, price floors for some commodities than prior to the COVID-19 pandemic, given the rising marginal cost of production. Remember Paul from the Sirius Report, who really just emphasized the whole point that it's all about energy, right? And, if your energy is high, everything else is going to be higher, including your metals. And it sounds like BHP is saying the exact same thing. And we have a quote from BHP, quote, "The lag effect of inflation," and we were just talking about this, "the lag effect of inflation and continued labor market tightness are expected to impact our cost base in the 2024 financial year," BHP said, as it logged a $1 billion inflation hit primarily from diesel costs for the half. So they talk about the lagging effects of monetary policy. I think there's something to be said about the lagging effects of inflation. Because now I get the sense that, ironically, as the Fed seems to be pivoting, or at least doing a semi-pivot or a halting of the tightening, it feels like now is when the inflation is hitting from over here, anecdotally. So continuing on, analysts at RBC Capital Markets said BHP's first half was, quote, surprisingly poor, but is a strong indicator of what is a still challenging inflationary environment for the miners, end quote. And again, you start to see the argument for the metals themselves in terms of an investment thesis, don't you? Because when you buy the metal, you're not worrying about the cost of energy for the miner. Okay, so, it's pretty interesting. BHP also said it expected aggressive global interest rate hikes from last year to slow growth sharply across the developed world. Well, when did they say that? That was probably before Powell's press conference that they said that. I wonder what they think now. And then here we have China. However, after a difficult first half, the miner said China appears to be a source of stability for commodity demands as the world's second largest economy and top metals consumer reopens and looks to revive its debt-laden property sector. And this property sector idea is something that Roberta Caselli mentions. She highlights it. She starts with it, that the property sector in China, should it stop falling, which it seems like it has, according to her, that could mean a heck of a lot for commodities, particularly industrial metals. So here it's being mentioned again. And the reason I emphasize it is because we don't really often hear of China's property sector as playing this pivotal role. But the more I'm reading here, the more I'm seeing, okay, China's property sector, we need our eyes on that. BHP's confidence in China's economy was buoyed by green shoots it has seen since the start of the calendar year, including new loans, house prices, and business sentiment surveys, CEO Mike Henry said, quote, "There's a lot there that has given us confidence that we'll see an acceleration in the Chinese domestic economy," he told reporters on a conference call. So, pretty interesting. Again, following mining sometimes feels like you're on the pulse of inflation to a certain degree. Continuing on, China's supply concerns boost aluminum prices. This is also Reuters via mining.com. Aluminum prices climbed on Tuesday to their highest in more than a week on output cuts in China, though rising inventories capped gains. Benchmark aluminum on the LME was up 0.6% at $2,472 a ton after touching its highest since February 10th at $2,485 per ton. China's Yunnan province has asked aluminum producers to reduce power consumption by 40 to 42% from September levels in the face of an ongoing supply crunch. So, interesting. And again, we're talking about aluminum as congealed electricity, and we have a quote from Suckden financial analyst Jordy Wilkes. Quote, "Aluminum prices have been supported by the prospect of capacity curtailment in China due to power availability. This could see output cuts as seasonal demand starts to pick up in March." I mean, again, from a geopolitical perspective as well, rising aluminum prices cannot be good for inflation in the West. And increasingly, what is Russia and China going to do as far as if they want to damage the West and fight back? What are they going to do? Are they going to get out their military? Or are they going to do inflation where basically they can say, look, it's just the financial markets. It's not us. Right? I mean, isn't that what you would do? That's what I would do. And I mean, again, Russia seems to be overtly doing it with the curtailment of oil supply. So continuing on, analysts estimate output cuts at smelters in China since the middle of last year will cut supplies in the top consumer to less than 40 million tons by the end of February. Aluminum stocks in LME registered warehouses have nearly doubled to 581,300 tons since February 6th. In warehouses monitored by the Shanghai Futures Exchange, aluminum inventories have jumped 360% since late December to 249,000 tons. On the technical front, support for aluminum comes from the 200-day moving average of around $2,245. I wish I asked Roberta about aluminum. There is simply too much to get through, but that would be fascinating. The next time she is on, we will have to do that. Continuing on, General Motors digs into mining business to lead race for EV metals. This is Bloomberg News via mining.com. And it says here, General Motors is trying to speed ahead in the race for metals underpinning the industry's shift to electric cars. The U.S. automaker is competing for a stake in Vale's base metal unit. Wow. Why is that not in the headline? They are competing for a stake in Vale's base metal unit, people familiar with the matter said this month. A deal may give GM access to the Brazilian mining giant's copper and nickel resources that are a key to making EV batteries. That is quite something. GM is competing for a stake in Vale's base metal unit. I mean, that is quite something. GM has made several such wagers recently, buying equity while rivals mostly sign supply deals. Wow. Last month, it bought a $650 million stake in Lithium Americas to help develop Nevada's Thacker Pass mine, which may support output of as many as 1 million EVs a year. I mean, literally, we're digging up the world's resources to make cars. I hope we all feel this is worth it. I hope this is all what we should be doing here. We're literally digging up what's left to make cars. In October, GM invested $69 million in Australia's Queensland Pacific Metals, a producer of nickel and cobalt. The moves are strategic bets to secure supplies that are getting increasingly sought after. And CEO Mary Barra said in an interview with Bloomberg Television in New York, quote, "We'll continue to work with many people in the industry, especially in lithium and the other critical minerals. I think we'll be positioned to have a competitive advantage." Wow. So that is happening. And get this, Rio Tinto partners with BMW for low-carbon aluminum supply. This is Cecilia Jamasmi on mining.com. And so BMW is looking for low-carbon aluminum, and Rio Tinto, they think, may be able to help them. Mining giant Rio Tinto has agreed to supply BMW with aluminum it produces in Canada using hydroelectric power in a move that will allow the German automaker to lower its carbon footprint. The companies, which announced the Memorandum of Understanding in separate statements, said the aluminum produced in Canada will go to BMW's production plant in Spartanburg, South Carolina, starting in 2024. While the partners did not indicate how much aluminum will be sent, they said the move could generate a reduction of up to 70% in CO2 emissions compared to BMW Group's benchmark for aluminum. And we have a quote from Joachim Post, BMW board member, quote, "By using innovative materials, we can reduce our vehicle's carbon footprint. The agreement to supply low-carbon aluminum is based on several pillars. In addition to hydroelectric power and secondary material, we also want to lead the automotive industry by ramping up our use of aluminum with no direct CO2 emissions from the smelting process." So I'm sure that's true, but I'd also say it's a very convenient way to say, look, we're getting CO2-free aluminum out of Canada. Rather than building that in Germany, we should build that in the US because it's actually going to be a lot cheaper to get our CO2-free aluminum shipped there. So German government, don't be mad at us if we're building in the US because we're doing it for the sake of the environment. Just speculation, but kind of fun to think about, isn't it? The companies have also agreed to work on deploying Rio Tinto's blockchain sustainability solution for aluminum called START, launched in 2021. So this is back to the traceability of aluminum and of minerals for their provenance, as Ira Thomas called it, in reference to diamonds. And we have a quote from Rio Tinto Chief Commercial Officer Alf Barrios, who said in a statement, quote, "As global demand for responsibly sourced materials continues to grow, automakers are increasingly looking to partner with suppliers who share their commitment to traceability and sustainability." Pretty fascinating. And remember Lynas in Malaysia having issues with getting certified for production after July? Well, we have an update here. Bloomberg News via mining.com. Minister signals Lynas can run Malaysia unit if waste taken back. So, Malaysia's science minister suggested Lynas Rare Earths could keep its unit in the Southeast Asian nation if the Australian company ships out the radioactive waste. And we have a quote from Minister Chang Lee Kang, who said in a tweet on Sunday, quote, "If someone is willing to ship the low-risk radioactive waste, as claimed, out of our country, the government can consider retaining CNL plant in Gebang." Well, you know, it's hard to argue with that logic. This Chang Lee Kang seems like a very skilled politician, don't they? Seem like a very, very skilled politician. Earlier this week, Lynas got its operating license for its Kuantan plant renewed for 3 years starting July 1st, but failed to get approval to keep running a unit that Malaysian authorities says generates radioactive waste. And Chang continues, "No party has the right to continuously produce radioactive waste in our homeland." Chang Lee Kang is an excellent politician from my perspective, and I'm not talking about ideology here. I'm talking about very powerful, simple statements. I mean, who's not going to agree with that? No party has the right to continuously produce radioactive waste in our homeland. A piece of political brilliance out of Malaysia. Continuing through the global south here, which increasingly our news is very much based on. Congo watchdog wants billions of dollars more from China infra deal. That's Bloomberg News via mining.com. I assume they're talking about infrastructure. I've never seen that shortened to infra in a headline, so a little surprised by Bloomberg there. The Democratic Republic of Congo's government watchdog called for a major overhaul of the country's $6.2 billion minerals for infrastructure deal with China after its investigations found significant breaches of the 2008 agreement. I think they're looking for breaches to renegotiate this thing. Congo hasn't been adequately compensated for the copper and cobalt reserves it contributed to the venture, which undertook to finance $3 billion of infrastructure projects using the proceeds of mineral sales from a $3.2 billion mine, the General Inspectorate of Finance said. It called for the value of the investment in infrastructure to be increased to, quote, at least $20 billion in view of the value of the deposits transferred, end quote. So there will be some surcharges on that deal. While the mine is pumping out metal, The Chinese partners have only disbursed about $822 million of infrastructure funding over 14 years, the IGF said in a summary of its findings published on its website on February 15th. Quote, these works have remained, for the most part, without visible impact for the population. The watchdog also accused the Chinese companies of financial malfeasance, including transfer pricing and dumping, and called for them to be fined $100 million for breaching capital controls under the nation's mining code by not repatriating more than $2 billion in export revenue. So this is pretty interesting, isn't it? In a separate statement posted on Twitter, China's embassy in Congo defended the partnership and said the IGF report, quote, did not correspond to reality, cannot be considered credible, and has no constructive value. Well, I think negotiations are not going to go well here. Quote, the Chinese government encourages the Chinese companies to work with their Congolese partner to improve cooperation by providing more benefit to the Congolese party and resolve disagreements through friendly and reasonable dialogue. The embassy said. It added that it would, quote, resolutely respond to any violation of the legitimate rights and interests of the Chinese companies. So, resources and geopolitics continue, again, to be center stage here in the relationships between countries. Newcrest CEO says ball in Newmont's camp in takeover talks. This is Bloomberg News via mining.com. Australian gold miner Newcrest Mining is, quote, worth a lot more, end quote, than the approximately $17 billion takeover bid made by U.S. rival Newmont, according to the company's interim chief executive officer. Quote, the company is not up for sale, and this was unsolicited, end quote. Sherry Dew said in an interview on Bloomberg, quote, we have offered Newmont limited conversations to share a bit more about where we see a value in the portfolio, and so obviously that's with them now to see if they'd like to decide to engage. Newcrest earlier on Thursday said it rejected the bid by Newmont, announced earlier this month, but indicated that it is prepared to provide access to limited, non-public information on a non-exclusive basis. And we have another quote from the interim CEO. Copper in particular in the portfolio is something that I would assume makes us very attractive to many people out there. The future for the metal is, quote, very bright. Yeah, as we'll see from Roberta Caselli, she was saying how Trafigura says there are only days of copper supplies when normally there are weeks. Think about that. Barrick CEO says inflation not over as costs weigh on results. Bloomberg News. So we see another miner is saying how inflation is reducing its profits. Barrick Gold's top executive says inflation is going to be sticking around to hobble the mining industry for a while longer. Despite expectations that the pace of inflation may start to ease as central banks ratchet up the costs of borrowing, Barrick's CEO Mark Bristow doesn't see enough to move the needle much. Quote, no one's doing anything to kill inflation, he said Wednesday in an interview at Bloomberg's Toronto office. Quote, it's definitely not over, end quote. And it's hard to disagree. If anything, again, we're seeing a leg in inflation. If you thought it was bad before, now is when it seems to really be hitting. Earnings of the world's second largest gold miner were affected by higher inflation and lower production in 2022, as well as, quote, challenges at its turquoise-rich mine in Nevada, according to Bristow. Quote, we missed the guidance on cost, but we guided that we were going to be higher because the costs came at us quickly. Still, the CEO sees some bright spots on the cost front, including an easing of fuel expenses due to a drop in natural gas prices. Labor is still high, though Bristow said Barrick is, quote, in good shape on that front, in part because it uses U.S. dollars for much of its business, including for its African operations in Mali and the DRC. Quote, the current year is a year where we've got quite a bit of capital. We've got to invest in more mining fleets, and so that does impact on the cash flow. And a couple of headlines here. This is the Northern Miner. Agnico Eagle shares sink despite record gold production in 2022. And this is Jackson Chen at the Northern Miner. Agnico Eagle Mines delivered solid operating performance in a challenging cost and workforce environment during the fourth quarter and throughout 2022, with payable gold production of nearly 800,000 ounces and 3.1 million ounces in these periods respectively. The company reported on Friday. That's pretty impressive. And we have a quote from Amar Al-Jundi, Agnico Eagle's president and CEO. From a safety and operational standpoint, 2022 was another strong year, and we had our best safety performance in our 66-year history. We met production forecasts and managed our costs in a highly inflationary environment. All-in sustaining costs for the fourth quarter and full year of 2022 were $1,231 and $1,109 respectively. The higher quarterly unit costs were affected by the impact of inflationary pressures at the Nunavut and Katilla operations and lower production at LaRonde, Katilla, and Pinos Altos, according to the company. So there you have it. And finally, Teck Resources becomes Teck Metals as it spins off its coal unit. So those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's just take a quick look at the 10-year bond, and it is at 3.912%. That is 0.16 higher than last week. So we have seen a general climb in the last 5 weeks, and we are nearing that 4% 10-year bond again. Let me just check before we continue here how the UK bond, 3.63%. Remember when it was above 4%, where, is actually at 4.5%, where all chaos started to break loose for the UK 10-year? Well, we're at 3.63. I mean, we're not that far. Looking at metal prices, we'd like to thank our friends at mining.com/markets for providing us with these prices each and every week. And on February 21st, gold is trading at $1,836.40 per ounce. That is $23 lower than last week. Silver is trading at $21.88 per ounce. That is 8 cents lower than last week. Platinum is trading at $943.56 per ounce. That is $16 lower than last week. And palladium is trading at $1,525.13 per ounce. That is $48 lower than last week. And turning to our industrial metals, copper is 5 cents higher at $4.09 per pound. Aluminum is a penny lower at $1.09 per pound. Lead is unchanged at 95 cents per pound. Nickel is 80 cents lower at $11.77 per pound. Tin is also lower at $11.84 per pound. That is 66 cents lower than last week. Cobalt is at $15.88 per pound. That is $1.47 lower than last week, and zinc is unchanged at $1.41 per pound. And that in itself is interesting because the zinc market is reportedly tight and copper is reportedly tight. Those are two of only a few metals that are not going down here. The others being lead, and aluminum is only a penny lower. Otherwise, everything else is lower. So pretty interesting there. And perhaps if you were trying to explain this, it sounds like the dollar is stronger in the last week or so. So perhaps that is what we're seeing here. Commodities, particularly gold, pull back and take a breather here. And those are your metal prices. And coming up, we have GlobalXETF commodity analyst Roberta Caselli, and she gives a fascinating interview on the dynamics behind the metals and energy markets as it stands. And perhaps, most surprisingly for me, perhaps not for you, but for me, was this idea of the Chinese property sector playing this pivotal role in industrial metals. And she's saying, as we see it stabilize, this could add pressure to already low inventories in places like the LME and the COMEX. Levels, as she said, and as we've been seeing in Bloomberg, levels are at a record low. So a fascinating interview. I hope you enjoy it, and I will see you on the other side. Joining me today, I am very pleased to welcome to the Northern Miner Podcast for the very first time, Roberta Caselli, commodities analyst at GlobalXETFs. Roberta, welcome to the program.
Thank you very much, Adrian.
So it's been an interesting time as ever in the last, 2 or 3 years in metals. One of the most pressing and, dramatic issues that I see when I look at commodities in general, particularly in the metals, is the question of inventories. And this idea, we've seen repeated reports out of Bloomberg of surprisingly low inventories on, say, the LME. Maybe we could start with that. What is your sense of inventories? Is this being over dramatized, or is this a serious cause for concern?
Yeah, I definitely agree with this consideration. From my point of view, I noticed the same. And I believe that, since last year, as you were mentioning, the two different reasons we have noticed in the exchange inventories, levels at record lows. For example, I think something to underline it is very important is that exchange inventories. So, for example, as you mentioned, LME, SHFE, and COMEX, for example, are not the entire stories, but they are a good proxy. So some of the inventories are more difficult to track. So, for example, the inventories in China, but just looking at exchange inventories once, as you were saying, I think since last year we witnessed to a substantial drop in mainly industrial metals inventories, such as, for example, copper and zinc too. For example, and I think that the reasons are different. So I would say, for example, on the copper side, one reason could be the strong demand linked to the energy transition, looking long term, or now the China's reopening narrative, but also supply disruption on the supply side, as we know in South America. While, for example, for other metals, reasons can be different. So just thinking about zinc, the production of zinc has been also affected, but then by the energy crisis that we witnessed in Europe, because the production of zinc is very energy intensive from that point of view. And so linking my comment to your consideration before, yes, I would say that is one factor that is very important and needs to be taken in consideration, because in the event of substantial drawdowns, I think that we could see traders trying to replenish their stocks, and this could put further pressure on prices and eventually spikes in the sense that there are concerns about shortages. And for example, just last quarter, Trafigura, among other industrial leaders, warned of copper inventories actually measured in days of consumptions rather than weeks of consumption. It is the typical measure. Now, I would say just in the last months, we have seen that metal inventories in the LME are still very low, but at the same time in China, due to mainly the seasonality linked to the New Year lunar period linked to the holiday, we have seen strong builds, and these are mainly seasonal. And I would say that now is important also to understand if we are going to see important draws, because earlier or more quickly than expected would be a confirmation that there is a strong rebound linked to Chinese demand from metals.
Fascinating. So just to clarify then, is what you're saying that you are starting to see the impact of China's reopening, or are you still kind of determining what that impact is?
Yeah, I believe that we have already seen, at least on pricing, a big impact. So, for example, copper hit just in January a 7 months high, mainly linked to the sentiment on China's reopening. But yeah, on the fundamental side, I believe the next weeks are going to be very important. One indicator, as I just said, is inventories. But on the other side, also the property sector is very important in order to understand how the China's reopening is going to impact industrial metals demand. Now, just to take a step back and trying to underline why China is so important for industrial metals and mainly copper, if we take it as an industrial metals benchmark. So I would underline here again that China actually accounts for more than half of the copper global consumption, and also the property sector is key. Indeed, the construction sector for copper accounts for about 30% of total copper end use. So we know that now lately China provided a large property sector rescue package, and just last week, for example, came out the news that China's home prices steadied in January, ending a 16-month decline. So I believe that stabilizing home prices is already an important factor for boosting buyers' confidence in new properties. And so, I would say that understanding if the property sector could again recover to last year levels is one of the key questions for industrial metals going forward.
And when you say property prices and just property development, are you talking about China or are you talking globally?
I'm talking now specifically about China, but of course the end use is not about China, but China, I would say, is the most relevant factor for copper.
Now, this whole story about copper is quite fascinating. I mean, when you say Trafigura says there are only days of consumption, to me that's a bit of someone waving a red flag here, but it sounds like it's still in equilibrium. And maybe I'm asking you to speculate a little bit before we move on to other metals here, but what happens if there's not enough copper? Like, I guess the price goes up and more copper shows up, right? Or not?
Yeah, I mean, the dynamic is mainly what you just described. Of course, it's important to take in consideration the lead times, the most of all are actually long. So if you think about greenfield projects, that takes around 10 years to be implemented, while brownfield projects that are the ones already initiated can take less. But in general, in order to supply to ramp up, of course, it takes time. Now, in regards to the mine production for this year, it is expected to increase basically following this inventory situation and also to face demand. But again, there are still disruption risks on the supply side, mainly in Chile and in Peru. We heard news about Las Bambas copper mine in Peru reducing, actually operating at reduced capacity. First Quantum is also something, the decision to halt production is something that we are closely monitoring now, because again could further exacerbate this price dynamic on risk of shortage. So I would say one of the main effects would be actually more volatility, and of course the first, until supply comes up, one of the first reaction is going to be higher, I believe, is going to be higher prices.
Right. And do you actually have a formal outlook on that you have over there at GlobalXETFs? Like, do you project into the future at all or not?
We focus more supply and demand forecasts rather than a specific price forecast. So I would say we look at, for example, the demand expectation from the International Energy Agency, that according to the energy transition demand for copper, basically the demand coming from clean energy and power grid and electric vehicles translates in copper demand expecting to double by 2030. So we take that in consideration. Also on the supply side, as I was saying, there are flags on potential supply shortage. And for example, one of the estimates I keep in mind is the one that Glencore mentioned just a few months ago of a 50 million ton supply shortage by 2030. So our approach is more longer term. And so rather than just focusing on cycles that are linked to macroeconomics and China's reopening more in the short term, we are focusing on the potential of a super cycle, looking more long term in the next 10 years, that we believe is linked to mainly the clean energy transition, and as we were saying, the lagging supply investment.
Okay, fascinating. So you are a proponent, or you guys generally agree with this idea that we are entering a super cycle.
Yes.
Okay, excellent. Fascinating. Now, just before we move on from industrial metals, I don't know, I assume you saw that story that was maybe a week or two ago on this kind of weird situation with zinc. I think that was at the LME. Do you have anything to say about that, or where they kind of ran out of like short-term supply and this sort of thing, and the price spiked on like 24-hour zinc? Was that just a market machination of some kind, or was that kind of a clue, into, it sounds like it's a very tight market over in zinc. I mean, you were mentioning it before. Do you have any thoughts on that?
Yeah, I believe one of the main reasons of the tightness in zinc at the moment is a consequence of what we have witnessed this last year on the energy crisis and the spike of the energy crisis. And the reason I say that is mainly because the production of zinc is very energy intensive. So, of course, a spike in energy prices, as we have seen last year, actually translated in halting production. And many smelters in Europe, for example, decided to suspend production, and the inventories, especially in the LME, of course, the low level of that is a reflection of it. So I believe that is a logical consequence of what we have seen and the announcements we have seen too.
Interesting. And since you follow this, I mean, energy prices have since come down somewhat in Europe. So are you seeing, the production of zinc then, or just these smelters restart, or are they still, basically, maybe it's still too expensive, even though the prices have dropped? Like, are you getting a sense that the smelters are restarting or not?
Yes, and I would say, yeah, at the moment the markets still look very tight. And for example, just looking at the forward curve, the market remains in a backwardation and still signaling insufficient short-term supply. But I believe that looking at the energy prices now and the consideration, as you were just mentioning, that at the moment, actually, we are witnessing low energy prices, I expect smelters reopening.
Okay, fascinating. Now, on this whole energy situation, I have a few questions for you. And of course, uranium and oil, I'm not sure which we should tackle first, but maybe since uranium is considered a metal, let's start with uranium. What are you seeing with uranium? I mean, people have been excited about this investment as long as I've actually been investing, since 2010. And just, maybe in the last 2 or 3 years, we've started to see some significant movement. What is your sense of the uranium market when you look out into the big world?
I agree with you, and I think that at the moment there is a lot of attention in uranium and nuclear energy. So, as you were saying, uranium is a metal, is actually a metal that enables nuclear reactors to generate electricity. So, it's the fuel of a nuclear reactor. And I think now the interest in nuclear power is mainly growing for a couple of reasons. So, first of all, the interest is linked to the energy transition. So, in order to reduce carbon emissions, but also linked to the energy security narrative, in order to find a dependable energy source, and also to meet expanding energy demand. And this is mainly because uranium is a clean source of energy. It is very dependable, having one of the highest capacity factors among energy sources, and is also cost effective. And I think looking shorter term, I believe also the Russia's invasion of Ukraine that altered the global energy landscape is one of the main factors contributing to the interest in nuclear power too, linking this to the energy security narrative. Indeed, I think with Europe in an energy crisis, countries worldwide may also begin to stockpile uranium for use as a backup power source. And indeed, we have recently seen that in December, the U.S. Department of Energy actually purchased around 300,000 of uranium in order to start this initiative of having strategic uranium reserve, as we have strategic reserves of other energy sources. But looking beyond this current crisis, the U.S. Inflation Reduction Act and the European Green Taxonomy actually positioned just last year the uranium as a climate change solution. And of course, considering the the nuclear, that uranium is the fuel to produce nuclear power, this would encourage investment in uranium too. And actually, another strong statistic that I keep in mind is the one coming from the International Energy Agency, that looking at the net zero emissions goals from countries, estimated that the nuclear sector must double in size over the next 2 decades in order to reach those net zero emissions goals. So the investment thesis for uranium is very strong, and many countries, we have seen so many countries' announcements lately, and I think the one coming from Japan is the most emblematic, also from a sentiment point of view, because after 10 years after the Fukushima disaster, now Japan, there is a shift back to nuclear, and now Japan decided to again invest in new technology and restart idled reactors. And as I was saying before, I believe the main 3 reasons for that is that there is a high efficiency of production of energy. If you think about the energy produced by nuclear fission is actually hundreds of times greater than energy produced by burning the same quantity of fossil fuels. And as I was saying before, it is cleaner and also stable. So that's why I think it's starting to become increasingly important and part of the world's energy mix together with renewables.
And tell me, do you know who the biggest buyers of uranium are as it stands, say in the last few months? Do you know that information?
So what I would say is that we are tracking on the demand side, which are the main players. And so far in the nuclear sector, I would say Europe and US are the main players in terms of nuclear capacity. So, for example, Europe accounts for 25%, while US around 19%. But looking forward, is important when looking at these markets also to take in consideration the timing of demand coming from new reactors. So looking forward, we see Asia to become one of the main players, and mainly China. China is one of the most ambitious plans. So its plan is basically to construct the reactors planned around 150 in less than 2 decades. And so on a quarterly basis, we monitor the different phases of reactors. So the ones that are operating. So to give you an idea, in China is around 50, the ones under construction, the ones planned. And so looking at the plan is also important to understand the demand going forward.
Interesting. And quickly, do you have an idea of when you're going to see the biggest sort of demand meet the shortest supply, when things are going to get at their tightest? Do you guys have a sense of that?
The sense that we have now is that already this year, next year, there is a moment where falling inventories and falling secondary supply is basically facing higher demand. So this is where we envision the deficit to be the biggest, I would say. And also because the construction of nuclear reactors takes time is something that we could see also in the next years. So I would say at the moment the deficit is linked to new demand, but is also linked to supply that needs to come up again and new investments on this side too.
Okay, excellent. Now, turning to oil, I mean, oil is such an, contentious market. I mean, there's a lot of people saying they expect it to go down, and there's a lot of people who say it's very tight. And look at the U.S. is releasing more from the Strategic Petroleum Reserve. What's your sense of the oil market? It seems tight to me. I mean, but I'm just someone who reads the news. I mean, what's your sense?
Yeah, I believe that these different views are actually justified by the several factors at play at the moment. And of course, one of the main factors is, again, China's reopening. And indeed, there is the expectation of a record in demand from China this year. But the hopes for a rise in Chinese demand for oil needs to be weighed against growing U.S. supplies and also worries about a slowdown. For example, just last week, we have also seen the news about the release again of 26 million barrels of crude oil from the strategic petroleum reserve from the US, while we expected a different policy this year. Actually, we expected the SPR to be replenished rather than again being released. And again, also from a macroeconomic point of view, is very important to understand how the central bank, the Fed, is going to continue its policy, if there is going to be a Fed's pause in its hawkish monetary policy, or if we need to wait more. But I would say overall, I agree with your view of markets still tight, and I also think that the conflict, the war between Russia and Ukraine, are going to continue to impact energy markets. So, for example, we knew that Russia was the world's second largest oil exporting nation, making up almost 10% of global oil supply, and we know already that already in January, Russia saw a 46% drop in oil and gas income. And also we have seen that, again, Russia announced the first time that an oil output cut in order to, that there was a kind of response to the restrictions in place. So we envision that there are still strong supply risks, not only linked to Russia, but also to OPEC Plus, that doesn't seem willing to increase production to compensate for this gap. So weighing these supply risks, even though we are witnessing growing U.S. supplies against China's reopening, I believe the market is still tight. And also on China's reopening, it's very important to underline that signs of revival in mobility are already visible. And for example, there was a significant increase in domestic flights during the Lunar New Year, and also the traffic in the main cities surged after the holidays. So yeah, there are different factors in play, and it's important to understand which are the weights to link to them.
Well, I tell my friends, buy your plane tickets now, because I'm already seeing, the prices for flights here in Europe have, come up. And exactly. I'm sure there's many, you've probably seen it too, right?
Yes.
And Airbnbs are expensive. Everything's going through the roof. If I could just get a very quick follow-up on oil long term, do you see it ultimately as a fairly tight market in the long term, or is it too early to say?
In the long term, it depends what we mean with long. It's true that if we look at the next couple of decades or even more, we know that we're going against a not favorable regulation, I would say, and a lot of attention is on renewables and the shift in energy markets. But I would say looking at shorter term, and also looking at the timing of the transition, I wouldn't envision this shift to happen suddenly, I would say. And I still see room to continue to invest, for example, also on the US side. Indeed, for example, next year, also the International Energy Agency expects a record in the amount of oil and gas production coming from the US.
Okay, very interesting. So just wrapping up then on gold, what is your sense of the gold market? I mean, people are starting to get, generally speaking, pretty bullish, thinking that this is going to be a good year for gold. We hear of pretty interesting stories in the last 6 months, let's say, of central bank buying. Do you have any thoughts on the gold market and where we are with fundamentals?
Yeah, definitely. So I would say that gold price moves in the last months have been, of course, linked to the Fed's monetary policy and the slowdown now of the potential pause and the slowdown that we have just witnessing of its tightening cycle. And of course, the main reason of that is that gold is a yield-free asset, and as we have seen last year, rising real treasury rates increase the opportunity cost of holding gold and can reduce gold investment appeal. Now that we expect a slowdown in a less hawkish path for Fed, that could suggest real rates and US dollar to lose some ground. And so this could support a case for gold to break out higher. Just in the last few days, though, we have seen that economic data was hotter than expected, and that dashed a little bit the hopes of the Fed's tightening cycle. And I've also seen that, for example, there are now again rumors of a bigger than expecting rate hike in the March meeting. But looking at the next year, in general, I believe there is a case to gold to break out higher, mainly linked to the narrative of a Fed's pause. But as you were mentioning, there is also another point to consider that is linked to the central bank's demand for gold, and this is linked mainly to geopolitical unrest that continues to encourage central banks to buy gold. And I would say also looking historically, gold, yes, is trading. The correlation of gold to real rates and dollar is very strong, and is I would say one of the main factors that influence gold. But on the other side, also geopolitical tensions and the possibility of persistent inflationary pressure also support gold.
Okay, and finally, just in terms of the inventories, do you have any sense of gold's inventory levels? Are they normal? Are they below normal? Are they, very tight, or is there plenty of gold in stock?
What we have seen, and for gold and silver too, actually, is that COMEX inventories and the London Bullion Market Association inventories have dropped quickly last year. And one of the reasons I can think of is, as I was saying, central banks buying in regards to gold, while for silver, we have seen high imports coming from India that could be linked to the solar panels investments. Actually, we have witnessed to a quick drop in both.
Okay, that is fascinating. So, Roberta Caselli, thank you for joining me on the Northern Miner podcast today. And if people want to learn more about GlobalXETFs and yourself, where should they go?
The best source, I would say, is our website, so globalxetfs.com.
Okay, excellent. Well, thank you again, Roberta, for the fascinating interview. It's wonderful to meet you, and I hope to meet you again on this program.
Thank you very much. It was my pleasure.
Well, thank you for joining us once again on the Northern Miner podcast. I hope you enjoyed that fascinating interview with Roberta Caselli. We're definitely going to have her back on. Totally interesting, people who are studying the fundamentals, actually looking at the supply and demand and the actual how much is out there and actually being able to give a good answer on that. That's real information, folks. That's real knowledge, and we're happy to bring it to you. Coming up tomorrow, again, is the Global Mining Symposium. Just go to events.northernminer.com to register your interest. If you want to help out the podcast, you can leave us a review in the Apple Podcast directory. Share it with your friends. And until next week, take care.